Equity research firm Hindenburg has just released a report highlighting that Equinix might have committed major accounting malpractice and manipulation to line the pockets of their executives. In this video, I'll be packing all of this down. I am Sam Kovacs, co-founder of the Dividend Freedom Tribe, a service which I market on Seeking Alpha with my father, Robert, where we help dividend investors build their portfolio so that they can live off of dividends in retirement. Members of our service get access to model portfolios, weekly buy, watch, and sell lists, and coverage on our universe of 120 handpicked dividend stocks, as long as a live chat where they have access directly to us. This is the title of the Hindenburg report. Equinix exposed. Major accounting manipulation, core business decay, and selling an AI pipe dream as insiders cashed out hundreds of millions. I mean, that sounds quite bad, right? So today I'm going to unpack this one by one, all these accusations. I won't be looking so much into the claims of the core business decay and selling an AI pipe dream, because I believe that's less relevant, and the most important bit is the accusations of accounting manipulation and malpractice. So what exactly is Hindenburg accusing Equinix of? Well, first let's understand exactly what it is Equinix does. Equinix is a real estate investment trust, a REIT, which leases rack space to firms to hold their servers in their space. They effectively lease space, power, and interconnection. As a real estate investment trust, they have to incur capital expenditure every year, right? There's a certain amount of capital expenditure which goes into maintaining the existing business and a certain amount which goes into growing new business or enhancing business. And what Hindenburg is saying is that management is classifying expenditures which should be considered maintenance as growth. Why would they do that? Well, Hindenburg say that it's because executive compensation is tied to the AFFO numbers. And so if they can manipulate the AFFO numbers, they can increase their comp. Seems like there might be something. Let's look into everything in detail and unpack it. When we look at Equinix's latest investor presentation, we do realize, of course, that their key priorities for delivering value to shareholders includes AFFO growth. Of course, this is nothing surprising for a REIT, but we must remember here that since AFFO is a non-GAAP, so a non-generally accepted accounting practice, it is subject to certain discretion when it comes to management's interpretation and presentation of the numbers. But generally, the investment community accepts that adjusted funds from operation is effectively funds from operation to which you subtract your recurring capital expenses. You also add back a few other small adjustments, line items, but which are usually minor compared to the idea of removing recurring CAPEX from the FFO. So this gives us an easy framework if we know that AFFO is FFO minus maintenance CAPEX, right? Why? Because if you want to grow AFFO, which of course both shareholders and management want, because shareholders will derive more value from a firm which generates more cash, and management gets more compensation. It seems quite aligned, right? The only thing is you can achieve that increase in AFFO now in two ways. The first is by increasing revenues, increasing profits, and the second one is by decreasing the maintenance capital expenditures, right? And let's not gloss over the fact that during the past decade, Equinix's management has done a brilliant job at growing top line and increasing EBITDA and cash flows at a very attractive pace. The business now generates nearly 4 times the revenue it did a decade ago, which is fantastic growth that very few firms in the big scheme of things have achieved, which reflects the increasing demand for data and that Equinix was the right firm in the right place in the right time for the huge increase in the demand of data that we've experienced in the past decade. Now, this does not change the fact that they might have been manipulating the numbers, though, does it? And Hindenburg makes a very nice case for this because Prior to 2015, Equinix's management's compensation was not linked to AFFO metrics. However, in 2015, all of their bonus compensation was now linked to AFFO performance. In this very same year, Equinix goes from reporting 9% of revenues as maintenance CAPEX to only 4% of revenues as maintenance CAPEX. Okay, so what's going on here? Of course, these expenses and expenditures didn't just disappear, right? As you can see on this graph, it's quite clear that the percentage of revenue declared as maintenance capex never returned to the pre-2015 levels. In fact, it's continued to trend downward year after year. In fact, when you look at management's guidance for the first quarter of 2024, as a percentage of revenue, maintenance capex is going to be as low as ever, between 1 and 2% of revenue. So we're now talking 4 to 5 to even, 9 times potentially less than it was in 2014. How can they do this? Remember, capital expenditures, what we were saying earlier, can be categorized as maintenance or growth. If you can find a way to convince your accounting teams and whoever's auditing your accounts that it is not maintenance capex, but it's growth capex, then you can categorize it differently, which will reduce the impact of capital expenditure on AFFO, which makes the number look good for the shareholders, is good for the share price, as long as no one picks up on it, and, of course, lines the pockets of executives. And during the past decade, executive compensation has ballooned as they've picked up just under $300 million in compensation over the period. Now, of course, they still would have done very well and picked up quite a significant amount of this had they not allegedly manipulated the numbers, but it would be lower, so it's worth investigating. Hindenburg says they interviewed many ex-employees, many ex-executives, which shed light on the practices that the company does to be able to classify routine maintenance expenditures as growth expenditures. And on this slide, I've highlighted a few examples. One of them is light bulbs. You run a data center, you're going to have to change quite a few light bulbs. Well, if you change fluorescence for LED lights, one employee says, that's a CAPEX. And so it's growth CAPEX, not maintenance CAPEX. You're not replacing light bulbs, you're enhancing. Another example they give is batteries. And they say that batteries are one of the worst costs for data centers because it just sits there all its life. You never use it because you very rarely have the power outages, which mean you need to move to your batteries. And so it's just sitting there getting charged, waiting, and then you have to replace it. Not a great cost, but a necessary part of the business as you're selling uptime and 99.9% uptime when it comes to Equinix to your clients. This seems to be a routine maintenance expense. However, if you don't just change the battery, but you change the entire battery system, you can maybe trick your accountant into believing that it is not maintenance capex, but an enhancement and therefore should be growth capex. And they also say that chillers are also something that no one wants to replace, but that you do have to replace them. And instead just classifying them as maintenance, well, Equinix have this very borderline practice of asking repaired chillers to be published with a new serial number, so that a new serial number won't seem like a replacement or repairment, but a total overhaul of the system and therefore can be classified as growth. Of course, taking out a battery and putting in a new one, taking out a light bulb and putting in a new one, or just replacing a chiller should not be considered growth capex because investors should expect to derive new returns from growth capex, and the growth that can be expected from replacing a battery system is, of course, extremely limited. Now, I believe that this can't just be a coincidence. Equinix's board has decided that it will look into the matter and give their opinion on what's going on. The Department of Justice has subpoenaed Equinix concerning this report, and I would stay away from the stock right now. It just doesn't make sense. Something here clearly smells. The sudden decrease from 9% to 4%, and the fact that it's been continuing to decline ever since suggests some form of aggressive accounting practices, to say the least, on Equinix's side. In an article which I just shared with members of the Dividend Freedom Tribe, I go into more detail looking at their claims that Equinix's core business is decaying and that they've been selling an AI pipe dream. But for this video, this is all there's going to be. If you enjoyed it, please click subscribe, as I will be showing more videos for dividend investors, overviewing either investments we've made in the past, reports that some well-known equity research firms have made on stocks, whether I agree, whether I disagree. In this case, like I said, I do agree. So make sure you hit that follow button. And if you want to join us on Seeking Alpha, well, the good news is that we've got a special offer for YouTube members, which you can see by clicking on the link that's in the description. We'll give you a 2-week free trial, an amazing introductory price, and you'll get access to a group of dividend investors who've been doing this stuff for decades. I said, this is a family business for us. We know what we're talking about. We've helped hundreds of investors. We've got a 4.9 star review. Most of everyone likes it. And if it's not for you, we'll give you a full refund. Anyway, I'm Sam Kovacs of the Dividend Freedom Tribe. Have a great day.